In the stock market rally we've been experiencing, it's becoming harder to find deals, but there is one stock in the sea of green that is red and possibly offering investors an opportunity, and that is Disney. Is Disney's pain your gain? Is Disney slowly dying, or are they just temporarily sick? Do we as investors have a ripe opportunity in an iconic company? I want to answer all those questions from my viewpoint, but before we get to that, let's look at my portfolio performance. This is me being transparent with you. If you appreciate this type of content, be sure to subscribe. These are all my stocks. I do have 3 in the red in the communication, 1 in the industrials, and you'll see an empty spot in the consumer staples. That's because I officially sold Tattooed Chef. I might provide more on that later, but I did do a short on it. But I'm up 13.98%. The market has been rallying as people are not expecting the Fed to go as hard on rate hikes anymore due to positive inflation numbers. But with that said, let's get into this video and let's find out if Disney is dying or just sick. To answer this, we need to look at the symptoms that are causing Disney's struggles currently. Struggle number 1, attendance is down at their theme parks. Discount offers are increasing and wait times for rides are shorter. That's good, I guess, if you go now not to have to deal with the crowds, but we are in peak summer months, so what's going on? On top of this, Disney has lowered its parks earnings forecast and are offering discounts for Christmas, which means they are expecting low attendance upon another typically busy time of year for them. Now, the number 2 symptom is high ticket prices. A Disney vacation is expensive. One-day tickets range from $110 to $200 per person. Consumers are complaining about this, and it's an issue for Disney. Now, the 3rd symptom is the political battle with Florida Governor Ron DeSantis, leading to woke and political backlash. I will get into this a little more later, but it is a symptom right now Disney is suffering from. And symptom number 4, possibly the one that is really causing this stock to go down, is subscriber losses on its streaming platform. This one we will get into some detail on because I have a lot of opinions about it. So are these symptoms of a dying Disney or just sick Disney that will recover? I think Disney is just sick, and I want to share 2 reasons why I think they are just sick and not dying. Reason number 1, Disney's not alone. Universal Park saw its lowest attendance on record this past 4th of July. Six Flags and SeaWorld also have recorded lower attendance in recent months. I think we are seeing a slowdown in the theme park vacation boom that occurred over the last 2 years. I knew many families that went to Disney over the last 2 years, but I'm not hearing about it as of recent. So I think it is theme park vacation fatigue, not a specific Disney thing. The other reason why I think they're just sick and not dying is I think it's a broader economic effect. Saving rates are declining, layoffs are occurring. Despite a positive trend with inflation decreasing, it's still prevalent and hurting people's pockets. Credit card debt is super high, and people are getting maxed out, and I think we did see a boom in vacation over the last 2 years, and now that may be cooling off as a lot of families got it out of their system and now have to focus on financial responsibility. So again, not a Disney specific thing. These 2 big reasons are why I think it's not solely a Disney issue, but more so a broader economic implication that is affecting Disney, and why I think they just caught a sickness that they will get over and are not a dying business. Of course, they have done some self-wounding themselves, but overall, I think it's in large due to the economy. So is this pain investors gain? Do we see an opportunity to invest in Disney? Let's check it out. Look at their stock chart. This is not a pretty stock chart. If you've invested in Disney over the last 5 years, it has not been good to you. Over the last 5 years, it's down 18%. And over the last 2 years, it's down over 54%, from a high of $197 to now flirting in the $85 to $95 range. So the question is, what are they doing to offset this lower demand and poor stock performance? Well, regarding the lower demand, they are answering with layoffs, about 7,000 jobs. This will help to reduce expenses to help offset lower expected revenue. Now, regarding their stock performance, Disney's dividend is expected to resume later this year, and that is something that will add some attraction from investors to invest in Disney. A dividend is a way to return profits to investors, and that is a good sign. So now we need to ask 2 other questions. First is, what do they have going against them? Kind of the risks. One is a string of poorly rated remake movies as of recent. Example, Pinocchio. Netflix seems to do it better with its own versions, such as Mowgli versus Jungle Book, and Pinocchio, they had their own version, yes, and it was much better. I have seen a few of Disney's remakes, and they lack emotion and substance. It's like they are approaching everything too carefully, and it makes the movie dull. This could cause future movies to be skipped by moviegoers as they view Disney as unable to create good remakes, which will result in less revenue. Of course, this is in their control though, and something Disney could turn around. So I see this as a possible temporary issue. The other thing is Disney's political fight with Florida Governor Ron DeSantis, which brings instability and projects the company in the limelight in a negative way. People start picking sides, and then you lose a whole customer base. I think if Disney backs off and is able to amend things with the governor somehow, it will fade within a year or two. Worst case scenario, keep in mind Ron DeSantis won't be governor forever, so there is a possible end in sight with this issue and something Disney can get over, and I think will be a forgotten issue within the next 2 to 4 years. Also with Disney, they're dealing with an economy spending slowdown, with consumers having to deal with a possible recession looming, lower savings, inflation, high debt levels, layoffs, which could affect them for years to come. But again, there will be a turnaround at some point. Another negative for Disney is their theme parks require a lot of capital expenditure. This forces them to charge more. This is something that I feel will be a forever issue with Disney, and is why they have to charge more in order to bring new experiences and upgrade current experiences. They need to keep people excited and coming back for more, and that costs a lot. This will be a seesaw issue, and I see as an uphill battle to continuously increase revenue in a strong trend over long periods of time against these theme parks that are expensive to run. And then another issue is streaming is still generating losses for them, though it is narrowing, so that's kind of a positive. They also have a decrease in subscribers, 2 quarters in a row now. The last quarter, they went from 161.8 million subscribers down to 157.8. That's a 4 million subscriber drop. Now, analysts say that less Americans are having kids, and this is the case in a lot of places around the world, but especially here in America. If your main streaming service, Disney Plus, is geared towards kids, this could be a long-term challenge. Disney does have Hulu, but with players like Netflix, Max, and Amazon TV, it's a very competitive market. Disney must figure out how to become profitable and how to attract more adults to subscribe by providing more adult content. They need to attract the adult audience, not just the kid audience somehow. With that said, the decrease in subscribers is not all bad news. The second subscription drop was driven by a 4.6 million sequential decline at Disney Plus Hotstar, the version of service offered in India and parts of Southeast Asia. Last year, Disney lost streaming rights to Indian Premier League cricket matches, which prompted them to lower future target growth rates. And in the US and Canada, Disney Plus lost about 300,000 subscribers, and Hulu, though, gained 200,000, and ESPN Plus gained 400,000. So again, the Hulu and ESPN geared towards more adults is doing well, where the Disney Plus is not. They're losing. So during Disney's earnings call with analysts, Bob Iger, the CEO, he said that the Hulu content will be introduced on Disney Plus later this year in a one-app experience. So that is something that I'm going to talk a little bit more about that I think is a positive. So it seems like they're making moves to increase adult engagement, and by these numbers, it has been positive. And I believe that the Hulu content on Disney Plus as one service will be a win for them. So a positive outlook for me with future subscriber growth. And even though Netflix is the only streaming company that is profitable, Disney's losses are narrowing, and I think they will get to profitability eventually. So now, what does Disney have going for them? Well, they have an incredible library of movies, franchises, and more that they own or co-own most of it. They have Star Wars, Marvel, Pixar, Fox, which has X-Men, and Avatar. That was a highly positive thing for Disney. They have Indiana Jones, ESPN, National Geographic, and so many more. In fact, they own over 200 companies. They also own streaming app Hulu, as mentioned, on top of Disney Plus, which will be merged into one app, but remains separate services. So consumers can choose to bundle or purchase one or the other, but accessing it all in one app, I think, is the more attractive thing to do. I think that's what will lead to more revenue and will lead to more consumers choosing the bundled option. It's always nice to have it all in one. Plus, Disney can better advertise all three services in one place, Hulu, ESPN, and Disney Plus, and make it more likely that consumers will bundle as they see content they want to check out on another service. I think this is a very smart move and will generate subscriber growth and revenue growth that will lead to a profitable streaming service eventually and offset some of those high expenses. Now, another positive thing that's going for Disney, besides their massive, awesome library of content that they own, the franchises, so on and so forth, is a strong history of magic and recognition by kids and families that I don't think will go away anytime soon. That will keep bringing in revenue as toys, movies, shows, theme parks, and more will be spent on by parents. Disney has some of the most well-known characters in history, such as Mickey Mouse, and they can leverage that in many ways. Disney essentially has what they need to succeed. There is no excuse. You just heard about their incredible library of content they own. They just need to do better in their delivery and think of new innovative ways to deliver that magic. Now I think we move on to financials. If we look at their stock facts chart, we will see here, again, they're about $90 per share. Their price per earnings is at 40 versus their 5-year average of 53. So that is signaling maybe some value there. Their price per operating cash flow ratio is at a 17.5, which I think is a little high because their last 5 years of cash flow growth is a negative 6.61. Their revenue over the last trailing 12 months is 12%, where their last 5 years revenue growth is lower at 8.72. So we do see some momentum as of recent versus the last 5 years, which is good. Their gross margin is good at 33.04, but their return on equity is low at a 4.32. Now their debt, I think that's nothing to be worried about. That's nothing that's alarming to me, so I think that's manageable. And again, they're currently not paying a dividend, but they expect to bring it back by the end of this year. Now going forward, analysts expect a 20% annual earnings growth over the next 3 years and revenue growth of 5% annually. Return on equity should improve from that 4.32 you just saw in the stock facts to a 10.8 in 3 years. So we're seeing a trend of improving financials, which is a good thing. So do I think Disney is a buying opportunity? I do think Disney has staying power, which speaks to its future. As iconic and recognizable of a company as Disney, it would take a lot to wipe them away. Out of all the theme parks, theirs is one of the most sought after by both kids and adults. Regarding their streaming services, Disney Plus could have some retention issues if the population of their audience dwindles over time. But other than kids, I know adults that subscribe due to the Marvel and Star Wars shows. So I see potential for Disney Plus to keep growing, but they need to increase this content and expand it to be more attractive to adults. Now, ESPN Plus I see as a clear win. If you love sports and subscribe, I think it is very likely you will keep this service. So it is a very sticky subscription. Hulu is one I see two sides to. This is their pure adult content play, but they have big competitors in Netflix, Max, and Amazon. I can name shows on all of these but Hulu. This is just me though, from what I see and watch. I cannot think of one show that is an anchor show for Hulu. But the others I can name at least one big one or multiple. So they have a big opportunity, but this is also where they have the most risk out of the three, and I think that's with Hulu. So let's now look at my quality checklist. This is my strategy to see if I want to invest in a company. And I usually like to have all or at least 5 of the 6 checked off. So let's look at financials, solid financials. Do they have that? Currently, they do not. We saw negative cash flow, low return on equity. They need some improvement here, so I'm going to give this an X. Do they have a good management team? Well, they got rid of Bob Chapek and they brought in Bob Iger, who they are extending his contract till 2026. I have more confidence in him than I did the other Bob, but again, I still need to see that proof. So this one, I'm going to say to be determined. Do they have positive brand recognition? Absolutely. This is a big green check mark for Disney, and this is going to help them provide that growth in the future if they can just deliver it in the right way. Now, what about their products and services? This is kind of a mixed bag for me. I don't think they really have the strong repeat customer or sticky subscriptions as other companies do. So that's a medium kind of rating for me. They definitely don't have customer dependency or a strong ecosystem like other companies. So I'm actually going to give them an X here in products and services. I think they need to improve here in order for me to turn that to a check mark. Now the moat. Do they have a moat? Yes, but I think it is small. I do think they have some competitive advantages, but not the competitive advantage over other companies such as Universal Studios or Netflix. They don't quite hold a monopoly or duopoly per se. It's shared amongst many others. And I do think this company can be disrupted. I really do. So I give the moat an X. I think it's small and they need to grow it to a large moat. They need to figure out how to do that. Now, is it at a good valuation? I think it's kind of fair valued right now. If they are to turn things around, I think it's a good buy-in price. But if things don't improve or they have many years of issues still to come, I don't think it's attractively valued. So I'm just going to leave this one as a to be determined as well. We're going to look at a few more things here in a second. So overall, I do see opportunity here, and I would be willing to open a small position. There are some decent risks, but overall I see more upside potential than downside. Long term, would I retire with Disney? No. So for me, I see a short-term play, 2 to 5 years maybe, but I don't see it providing the growth of Microsoft or Apple over the next 10 to 20 years. Disney does not provide those products and services we depend on like those companies. We can easily live without Disney. It's much harder to live without Microsoft if you're a business, or Apple if you're in their ecosystem, and this is my opinion, of course. These types of companies are the long-term winners, but Disney does not have an ecosystem nor moat yet that I can have high confidence in long-term success. Now, it's funny, as I just received this in the mail, a Disney credit card that offers Disney benefits. What timing when I decided to do a video on Disney. So I see this as an opportunity, like as with Southwest Airlines and their credit card. People love to get mileage points, to get free flights, and I can see this as a kind of small win for Disney, but the difference is, how often does the average person go to Disney theme parks? Not very often compared to flying on Southwest, going on vacations every year. So I don't see this as being massively popular, but could get some extra traffic from customers and might be a small benefit to Disney. Overall, I think Disney is a buy at or below $90 per share for a 2 to 5 year play. As a long-term hold, I do not think it's attractive enough or as good of an investment compared to other stocks with stickier ecosystems or larger moats. And Disney still has a lot to prove, I think, in order for me to put some money in. But again, a 2 to 5 year play, I can see arguments for that, and I think that's something that I could see myself doing. But right now, I'm still holding off on both options. So let me know if you think Disney is a buy and if you think it's a good short-term or long-term hold. And thank you guys for watching, and we'll see you next time on Mark Arnold's Finance.